Great to be here. Thanks for having me. It's always a pleasure. So I'll just go ahead and dive in. We have about 40 minutes together, so I want to make sure that I cover everything. We have lots of great stuff to go through. We'll be discussing the golden one-day options trade. These are power play trades for volatile markets. Before we dive in, I'll just cover a brief disclaimer with you. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We will be going over some various results on our session today, and I do my very best to share real world, real money results. Just to really reinforce what I'm teaching and show you that it actually works in live markets. But do know that due to the time critical nature of trading, brokerage fees, activity of other traders, we don't guarantee that anyone will mirror the performance of anything I share on the session today. All right, so with that out of the way, by the end of our session, you're going to discover one trade setup that has the potential to profit regardless of whether the market goes up or down. So these are opportunities that occur on a regular basis with astounding reliability. And whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. And we're going to talk about why that is, because markets have certainly become more volatile, more erratic. And when we look at what makes trading or investing difficult on us, there's a host of reasons. But when it comes to directional trading, one of the most difficult aspects of trading is accurately and consistently forecasting and timing market direction. You can imagine if you had a crystal ball that told you exactly where the market was going to go, whether it would be up or down, that would make things a whole lot easier. I mean, you could still fail with poor money management, risk management, et cetera, but that would make things a whole lot easier on us, right? And so this is one of the main difficulties that we face in directional trading. And this is part of the reason for that. So as I just mentioned, markets have become more volatile, more erratic. This is an interesting graph that's put out by the St. Louis Fed Tracker, looking at equity market volatility. So this is over the course of about a year. And I'll just point a couple things out, right? We see over a period of many months, a steady increase in volatility, right? And then we see extreme levels of volatility, like we just saw in March and April, that then quickly contracts or evaporates, right? It gets crushed. And so the other thing to point out here is the erratic nature of volatility, that it can increase very rapidly and then also decrease very rapidly. So this can make it difficult for directional trading. All right, and so the golden one-day options trade is going to address these issues, because what if you don't need to know whether a stock will go up or down or even when? Okay, we're going to eliminate this difficulty using the golden one-day options trade. So what I'm going to give you today to make this all easier is, number one, you'll discover the golden one-day options trade. I'll show you how to identify the setup, how to trade the setup, how to profit from the setup, how to apply the setup to any optionable security. We'll look at some real world, real money trade examples together, and then stick with me to the end. I'll show you can get expert guidance to do this for yourself in the live markets. So I'll just give you a brief background on myself before we dive in. Again, I'm Jeff Tompkins. Pleasure to have everybody here today. And I have over 2 decades of experience trading the stock options and futures markets. Received my professional training as an intern at the trade desk at Morgan Stanley back in the early 2000s. And we just are coming up on our 10-year anniversary. So 10 years ago, hard to believe it's been a decade, I founded Altos Trading, where I currently serve as the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. I'm also a hedge fund manager, so I manage money for my clients at Altos Capital. And I'm going to be sharing some of the methodologies and institutional level tools, tips, and tricks that are highly underutilized in the retail trading crowd. So you're going to get a real special insight, unique insight into institutional level tactics, okay? And as you can see, I'm also a keynote speaker and educator. This is one of the things I really love to do. Trading, investing can be a lonely endeavor. So I really enjoy getting out and teaching other aspiring retail traders and watching them transform from areas where they might be struggling to more consistent and confident results. So this is me up on the stage at one of the recent International Traders Expos, and really, again, why I love to do this. So let's start to dive in. What if we could profit if the market goes up or down? So I mentioned we're going to eliminate that difficulty of having to predict the direction of the market. Okay, and we call this a market neutral strategy. So the exciting thing is there are no special indicators needed. So you don't need a MACD, a stochastic, an RSI, a Fibonacci. Okay, you can do this without a single indicator. There's no complicated chart analysis. In fact, you can do the golden one-day options trade without even referencing a stock chart. All right, because this is based on a very simple, but again, highly underutilized statistic that you're probably not using in your trading decision. And even if you don't trade options, okay, this is important. Even if you do not trade options, you need to be using this number to make more informed trading decisions. Okay, this is again a number that is used widely in the institutional trading world, but highly underutilized in the retail trading crowd. Now we are going to incorporate a little bit of chart analysis. Reason being, it can give us a little bit of an extra edge in this trade, and I'll explain that. Okay, now we don't need to guess trend direction. Okay, there's no need to time the market. There's no uncertainty when to take profits. We always know what our profits are before we even get into the trade, what our profit potential is. Okay, this is all a proven strategy based on statistics. So I'm going to be talking a little bit about statistics, nothing complicated, very easy to do. In fact, your broker platform will give you all this information. All right, but again, it's critical that you use this in your trading decisions. All right, and we're going to build this into the golden one-day options trade. So you're going to discover why volatility is one of the only leading indicators of impending trends, how to identify when markets may be primed for a big move, how to build a trade that can profit regardless of which way the market goes, how to set accurate profit targets with limited defined risk. So these golden one-day options trades always have limited defined risk. We know what it is up front before we get into the trade, and as long as we adhere to our, our risk management principles, then it can't be exceeded. All right, we're going to look at how to play smart money trades. What do I mean by that? I mean that, again, this is information that is used consistently by institutions, okay, but highly underutilized amongst the retail trading crowd, and there's a whole lot more. So let's start to dive a little bit deeper. We're going to start out by talking about volatility. So there are different types of volatility, namely historical volatility and implied volatility. And so we're going to focus on the latter, implied volatility, which can be a very reliable forecasting tool. And it's basically the option market's forecast of future price movements, and it can tell us with a high degree of accuracy how much an underlying asset's share price is expected to move or change by a future date. Okay, and it's readily available on any options chain. So you can get this right out of your broker platform, and it's going to actually tell us the exact number of points the market is forecasting the asset to move up or down. Okay, so imagine what you can do with that. You can use it to set realistic profit targets. Realistically define your risk. You can use it to structure options trades, which is what we're going to be doing. Okay, so let's just give a quick high-level overview of implied volatility, because I want you to really have a good understanding of this before we dive into the golden one-day options trade and how we use it to predict the move. So implied volatility is a measure of how much the market expects the price of an asset to fluctuate in the future. Okay, and it's a key factor in determining the price of an options contract. So there's a direct correlation. When levels of implied volatility are high, the option premiums become relatively more expensive, and vice versa. When IV is low, right, premiums are relatively inexpensive. Okay, so traders typically use IV to gauge whether options are cheap or expensive, and to determine the possible outcome in an options trade. Now, it's influenced by supply and demand, and the market's expectation of the amount a stock will move. So it tends to increase ahead of a major announcement or event, and then decrease after the event has passed. So the example I like to use is a company's quarterly earnings. When that quarterly earnings date is approaching, right, there's uncertainty about what the outcome is going to be. Okay, whether they're going to beat or miss on top and bottom line earnings, and what the forward guidance is going to be, and how the market's going to react to all that. So there's all these unknowns, and therefore you're going to see implied volatility, which is forward looking and projecting the future, increase, right? Now, once that earnings announcement is made and those results are known, implied volatility drops off a cliff, right? That level of uncertainty is now gone. We now know the answer to that binary question, and there's no more uncertainty. Okay, and so we call this IV crush. Now, there's different ways to measure implied volatility. When we look at implied volatility percentile, we measure it on a scale of 0 to 100. So this is my interpretation of different levels of implied volatility. I consider 0 to 20 to be extremely low, 20 to 40 quite low, 40 to 50 in the medium range, 50 to 80 moderately high, and then anything above 80 I consider to be extremely high implied volatility. Now, IV forecasts the expected move up or down of the underlying security with remarkable accuracy, but it's not perfect, and that's okay. We don't need it to be perfect for the purposes of the golden one-day options trade. In fact, it can be exceeded as much as it wants, and that's all the better for us. But it's very, very unusual that an expected move is not achieved by a future expiration cycle. And I'll show you that in some examples. Now, it doesn't tell us which direction the underlying stock will move. And that's also perfectly fine, because we're going to be building in market neutral strategy. We don't care which way the market goes. It could skyrocket tomorrow, or it could tank. It doesn't matter. Okay, either outcome is good for us. So let's take a look at this on an options chain, okay? And this is not a current chain. This is from the past of the SPY, the S&P 500 ETF, from back on October 6th of last year, okay? So I'm gonna point a couple things out. If we go over to the right, we're just gonna go 1 day out in expiration. So we're going out to October 7th, the very next trading day. If we go over to the right of the options chain, and by the way, I'm doing this out of the Thinkorswim platform. This might be found in a different spot on your respective broker platform, but it should be in there somewhere. If you can't find it, obviously contact your broker, or I'll give you a quick and dirty way to estimate it in just a second. But let's get back to that number and percentage. So if we go over to the right of the expiration cycle, we see a percentage followed by a number. Now we're going to ignore the percentage. It's basically an annualized volatility percentile. What we want to pay attention to is that number. So notice how it says plus or minus 3.98. All right. Now we can round up to or down to the nearest whole number. So we'll just round this up to 4. So what does plus or minus 4 mean? Well, at this point in time, the SPY is trading at 572.98, so right around 573 a share. This is telling us that on October 6th of last year, over the course of the next 24 hours, so by October 7th, the very next trading day, the market is expecting this SPY to move up or down by roughly 4 points. Okay, that's what the expected move is. That's what that number is telling us. So probably some light bulbs are starting to go off. You're starting to think, wow, this is good information to have. Even if I'm not trading options, let's say I'm just buying shares of the SPY and it's a day trade and I'm looking to get out in and out intraday and I need to figure out a profit target. Well, if I buy in at the current price, right, on that particular day, let's say I buy in at 573 a share, do I want to set a profit target, let's say 580? No, that would be way outside the expected move, and you'd have a very low probability of hitting that profit target. Or do you want to set a stop loss at, let's say, 570? Well, that would be inside the expected move. So you'd have a very high probability of getting stopped out. All right, so there's all kinds of ways we can use this. Now, if for some reason you're not able to find this in your broker platform, a quick and dirty way to estimate it is just add up the at the money straddle. And what that means is you take the strike price that's closest to the current underlying share price, and that in this case 573, and you just add up the premium on the at the offer on the call and the put side, right? And that's going to give you a pretty rough estimate of what that expected move is by that future date. All right, so let's start to build some strategy into this. We're going to be looking at non-directional market neutral strategy. So we don't care which way the market goes. It again could skyrocket tomorrow, or we could have a black swan and the market sells off. Okay, it doesn't matter. Now, there are a number of different market neutral strategies. I'll go through some of the common ones and why we actually won't want to use these. So one is an iron condor. Okay, now this strategy has the potential for consistent gains, but it carries high risk relative to reward. So it has what we call an unfavorable risk reward skew, meaning you could have a series of like 10 winners that's then wiped out by one bad trade. All right, and so iron condors might be appropriate for the right circumstance. And we actually do these at Altos from time to time, but we're not going to be using these for the golden one-day options trade, okay? Another common market neutral strategy is the iron butterfly. So this strategy has limited risk and limited reward, and it basically profits when the underlying asset stays within a narrow range. Okay, so again, it's non-directional, but you have to be pretty precise about where the underlying asset ends up by a future date. Okay, so there's a pretty big challenge behind that. So we're not going to use iron butterflies for that reason. Another is a short strangle. Now, short strangles have limited profit potential. Okay, it's limited to the credit you receive when you put the trade on with unlimited directional risk. So it can experience heavy losses when the market makes a big move. So kind of like iron condors, right? You can have a series of successful trades that's wiped out by one bad trade. So we're not going to be using short strangles. What we are going to build into the golden one-day options trade is a long strangle. So a long strangle has limited risk, okay? And we'll look at some examples here. We always know our risk up front, and it has unlimited profit potential. And there's also no need to guess the trend direction. Again, we don't care if the market goes up or down. It could go either direction. So this is what we'll build into the golden one-day options trade. So I'll just give you a high-level overview of this strategy if you're not familiar with it, okay? It's an option strategy where the trader buys a call at a higher strike price and then a put at a lower strike price with the same expiration date and the same underlying asset. Okay, and it's used when the trader believes the underlying asset will make a large price movement, but is unsure of the direction. As I mentioned, it has limited defined risk, so we always know our risk up front before we get into the trade. Okay, an unlimited profit potential to the upside, substantial profit potential to the downside. Why is it not unlimited to the downside? Because the stock can't go below zero. Okay, but theoretically, it's got unlimited risk or a reward potential in either direction. Okay, and it's also not necessary to predict the trend direction. Okay, so this is market neutral, and the trader can profit on a significant move up or down in the underlying asset. Okay, but you have to know what you're doing, and I'm going to show you exactly how to do this. Now, if a strong directional move does not occur by expiration of the option contracts, the strategy can be adjusted to mitigate risk and even generate a net profitable outcome. So I'm going to be giving you a few adjustment techniques on the session as well today. Okay, so we're going to build one more thing into this, and that is 0 DTE, or 0 days to expiration. All right, and if you're not familiar with these, they're relatively new amongst the retail trading crowd. They were introduced back in 2022 when the CBOE, or Chicago Board of Options Exchange, announced that it would issue weekly options with expiration days on each day of the week. So this isn't available for all assets, but it's becoming available for more and more assets. But these are basically option contracts that exist for a single trading session and then expire on the same day that they are traded. And what's interesting, and this was data that was put out recently by the NYSE, a huge amount of retail trading volume is now focused on these short duration contracts. So in fact, 56%, I think this has even gone up since this stat was put out, of retail options volume is in contracts with 5 or fewer days to expiration. So what this means for us is there's incredible liquidity in these trades. Okay, it's very easy to get in and out of these. And why are we incorporating 0 DTE, right? Why not do these like 30 or 60 days out? Well, 0 DTE options are significantly impacted by short-term moves in the underlying security. And I'm going to elaborate on that because it's really important. But what you need to know, what this means for you, is there's significant profit potential for those who know how to take advantage of it. And you will know how to take advantage of it by the end of our session today. So why do we use 0 DTE? This ties into gamma, okay, which is one of the options Greeks, right? You have delta, gamma, theta, vega. And gamma is basically the rate of change. And by the way, this is just for, I don't want anyone to get scared away. This is just for background knowledge, okay? You're not gonna have to calculate this or really know it. I just want you to understand why we're using it. But it's basically the rate of change for an options delta based on a single point move in the delta's price. So it's a risk metric that measures how quickly an options delta changes in response to a $1 change in the price of the underlying asset. So here's the important thing. For 0 DTE at the money options, gamma's at its peak, which means that small changes in the underlying asset's price can lead to large changes in the options delta. So a good example is if you take trader A and B, okay? They both do the exact same option strategy on the same underlying stock, the same strike prices. Everything is the same except the expiration cycle. One does it on a 0 DTE contract, the other does it, let's say 30 days out in expiration. Okay, they're going to be exposed to the same movement in the underlying stock, okay, at the same strike prices, right? Even same position size. They can both put on the exact same number of contracts. Okay, the short duration position, the 0 DTE, is going to behave much, much differently on a directional move versus the 30-day contracts. Okay, so this is why we use 0 DTE. We're going to harness this to our advantage. All right, it can benefit the savvy short-term trader who understands how to harness it. Okay, it can also work against you, so you need to know what you're doing and use this the right way. And again, you'll know how to do that. So let's get back to this options chain of the SPY. All right, again, this is back from October 6th of last year. And we've already identified, okay, that the SPY is trading around 573 a share and has an expected move of about 4 points over the course of the next 24 hours. Okay, so we're going out to the October 7th expiration cycle. So even though I'm saying 0 DTE, we will also use 1 DTE contracts with the golden one-day options trade. We just don't want to go beyond that. Okay, so we now know with a high degree of certainty that the SPY will move up or down by at least 4 points. Okay, it may move more than that, but it's highly, highly unlikely that it will not move at least 4 points. It's possible, but very, very unlikely. Okay, so what do we do with this information? Well, this is where step 1 comes in. So I'm going to give you the step process for building the golden one-day options trade. Step 1 is to buy a call and a put with strikes near the outer edge of the implied move. So we're simply going to add and subtract that expected move number from the current underlying share price to select our strike prices. Okay, so if we add it, that's going to tell us to buy the 577 strike call. And then if we subtract 4 from 573, it's going to tell us to buy the 569 strike put. That's how we're using this number. So we are looking, and again, we don't care which way the SPY goes. It could rally to the upside, it could sell off to the downside. Okay, we're just looking for that expected move to be fulfilled. All right, now, as with any strategy, we need to define our risk and reward. Okay, so with the long strangle, okay, our risk is defined. The maximum potential loss in the long strangle is the premium we pay for the contracts. Okay, so there's no need to use a stop loss or try to guess where you should get out. Okay, you're not going to get stopped out of a trade. Okay, you don't need to wonder where should I get out. We always size for 0. Okay, in the event of an adverse move. Now the fun part is defining the reward. So with these trades, it is very realistic, okay, to set a 50 to 100% ROI and achieve that in a single day. So we're targeting 50 to 100% return on our capital. We're simply going to add up the premium we paid for the put and the call contracts and predefine our exit price. We don't need to identify profit target levels on the chart. We don't need to do any fancy technical analysis, none of that. Okay, so we're going to start walking through some examples. Okay, that's where step 2 comes in. So we're going to add the put and call premium to determine our total risk. Okay, what's really exciting about these trades, you can do these in small accounts. Okay, in this particular example, okay, if we add up the put and call premium, we pay 27 at the offer on the call side, 66 at the offer on the put side. We can put this trade on for 93 bucks. Okay, if you just trade a one lot, you can do this for 93 bucks. Okay, so if you're just starting out, you have a small account, this is very small account friendly. It can also be done inside retirement accounts, and it can also be done inside large accounts. So this is totally scalable. Okay, you can scale this up based on your account size and your risk tolerance. Okay, when we go through our examples here in just a second, we're going to use 10 contracts. So we're going to be using a 10 lot as our examples. That's typically what we trade with our members at Altos. Okay, so the cost of the spread is $93 a contract. Now, we want to set our profit goal and determine where we're going to get out of this trade. Okay, so there's kind of 2 approaches to this, right? And the reason I'm going to break this down for you is I'm going to tie it into the approach that I like to use, because we can just take the premium that we pay, okay, 93 bucks, and double that, right? So we're going to get $1.86. That part's easy. And then we can just place one single limit order to get out of the trade. So if the SPY goes up, right, we hit our profit target, our limit price of 186, we get out with a profit. If it goes down, we hit our limit price of $1.86, we get out of the whole position with a profit. But what I like to do is set 2 separate limit orders, one on the call side, one on the put side. And the reason for that is, if we get in volatile market conditions, and this is what you'll typically see when other traders are getting whipsawed, right? You might have an early day sell-off, and then it reverses intraday, and the market rallies. There are occasions where you can hit the profit target on both sides of the trade. So you can hit it on the put side and then on the call side. So I like to use 2 separate limit orders. Okay, that's just a little pro trick. All right, so let's go back to the chain. Step 4 is to submit our GTC, that means good till canceled, limit order for both the call and the put side. So we're going to place a limit order at $1.86, okay? And we'll, again, place that 2 limit orders, one on the call side, one on the put side. Let's see what happens. So we fast forward to the very next day, October 7th, okay? What did the SPY do? And again, we didn't care if it went up or down. It could have gone either way. In this case, it went down, and it didn't go down by any tremendous magnitude. It wasn't anything, some crazy sell-off or market crash. It was down less than 1%, 0.95%. Look at the move, 544. So did we hit that 4-point expected move? Absolutely. In fact, we exceeded it, all the better. Okay, so we moved down 544. Okay, we could have easily gone up 544. That would have been fine with us too. Okay, what happens to those put contracts at the 569 strike? They hit a high on October 7th of 254. Now remember, we would have paid 66 a contract for these, and we had a limit order in at $1.86. So we easily hit that 100% return in a single day. So on a 10 lot, that $930 investment turns into a $930 profit in under 24 hours. I'm going to show you some actual real examples that we did with our members at Altos. Okay, we're typically in these for very brief periods of time. Okay, this is one where we did a 1 DTE. okay, back on September 16th. Okay, we alerted our members to set up a long strangle on the QQQ. Okay, we used the expected move. We made sure the levels of implied volatility made sense. Okay, we weren't trading in an environment where we're going to get vol crushed. Okay, and this trade can be put on for $1.45 debit. That means you can do this trade for 145 bucks on a one lot. Okay, again, we'll use 10 contracts. This is what we traded. So we did 10 contracts. That's an investment of 1,450 bucks. Okay, this trade was put on right within like 5 minutes of market close on September 16th. Okay, it was exited minutes into the open the next day for a $2.15 credit. Okay, that's a 50% ROI in under 24 hours with just minutes of market exposure. Now, I want to give you guys a pro tip. Okay, you need to be careful about vol crush. So that was that example I gave about a company's quarterly earnings announcement. So vol crush occurs after an anticipated event that results in contraction of price movement. So because implied volatility is a major component of options pricing, like I previously explained, it can cause the options premium to decrease rapidly, which can negatively impact the value of the calls and puts in the strangle. Now, long strangles benefit from an increase in volatility. So we want to place these trades when we expect volatility to increase or remain high. And what's really exciting is we're now in a market environment where we can start really putting a lot of these trades on because the VIX just got crushed. It spiked recently, and now it's back down at low levels, and it's likely going to start increasing again. This is what you want to look for. Now, I mentioned we don't need to use a stock chart to even do this trade. Okay, you just need that one simple statistic, the expected move. Now, we'll build a little bit of chart analysis into this for those of you who like to do chart analysis. This can give you a little bit of an extra edge and help you kind of visualize whether we're in vol expansion or contraction. So it's important to know that volatility always alternates between contraction and expansion. Okay, and this is actually a real price chart. It doesn't matter what stock it is, but I'll show you how to visualize this. So we simply look at the high-low range, okay, of the daily candle. So a narrow high-low range indicates contraction. A wide high-low range indicates expansion. Okay, so we just take the high and low of the daily candle, okay, to gauge whether we're in vol contraction or expansion. So if we look at this chart over on the right, what do we notice in that first daily candlestick? It's relatively narrow compared to the next one over when we look at that high-low range. So that tells us that we're transitioning from vol contraction to vol expansion. And notice how that high-low range continues to widen, okay? But we always alternate. So when we're in vol expansion, we know with certainty that we're gonna transition it into vol contraction. There it is, the high-low range narrows. And then we go from what? Contraction to expansion, to contraction to expansion, to contraction to expansion, to contraction and expansion, so on and so forth. Okay, so this can kind of help you determine when the best time to put on a golden one-day options trade is. Okay, now there are going to be occasions where things don't go as planned. Okay, so maybe that expected move doesn't get fulfilled. It's a relatively small percentage of the time that expected move doesn't get fulfilled. Very unusual. Or maybe you just put the trade on and got caught in vol crush. Okay, but something doesn't go as planned. Well, we can adjust this trade as well. So I'm going to give you some different techniques to adjust a long strangle. A couple of things I like to do is to sell premium on both the call and the put side when the market doesn't move as expected. So there's really two types of trades I'll convert the long strangle into. One is an iron fly, an iron butterfly, or an iron condor. And this can help bring in premium to cover the loss in the long call and long put when the market is flat in vol contraction. Okay, and when you execute this correctly, this adjustment technique can mitigate a loss and even transform a losing strangle into a net profitable spread. In fact, we've done this recently with our members at Altos, where we put on a golden one-day options trade, didn't get the expected move, sold premium. I think we converted to an iron fly and brought in premium that exceeded the debit we initially put into the trade. The market stayed flat, that premium eroded, we captured that, and actually came out with a net profit. Okay, so those are some ways that you can adjust. Now, strangles can be traded within small accounts. Okay, you can start with as little as $500, as I showed you in that SPY example, right? You can put that trade on for literally $93, and that's a pretty reasonable price range to expect. Okay, typically we're somewhere between $90 and maybe $110 a contract. All right, now I'm going to make an exciting announcement here, so you can learn to do this for yourself and follow along as we do this. Now, we've been doing this for many, many years. You know, as I mentioned, I've been, trading options for over 2 decades. I've gone through all the trials and tribulations. I've blown up accounts, lost money. And so it really, took me well over a decade to figure this all out and really start using institutional level tactics, strategies, methodologies that actually have a positive expectancy and make money over the long run. And so this is what our trade room is designed to do, is to give you guys that ability to start using institutional level tactics, okay, in your trading. And we don't just pigeonhole this to one strategy or one market. So this isn't just the golden Monday options trade. That's just one of dozens of powerful strategies we use inside of our live trading room. We also trade equities, ETFs, other option strategies, futures, currencies, even crypto. Okay, so we do it all. We're not a one-trick pony. We have a whole toolbox of very powerful strategies that we use, and the golden Monday options trade is just one of those. All right. So again, I mentioned I like to back up everything that I teach with real world, real money results. This is a 1 week snapshot. Okay, it's not cherry picked. It's not only some of my trades and I left others out. It's a 1 week consecutive snapshot of the golden Monday options trade on the S&Ps. Okay, and most people are surprised to know I'm not trading some crazy position size. I'm not trading 100 or 200 contracts, right? I'm only trading a couple of contracts here. In one case, one, and I only adjusted one trade, okay, on August 5th. All of these were winners, okay? Now, that's not to say we don't have losing trades, okay? But when done correctly, this can be a very, very consistent strategy. So this was done right out of my personal trading account. I booked just under $4,000 just doing a couple contracts over the course of a week. As I mentioned, we also do futures. So I'm going to be sharing with you, and I will let you know here in just a second how you can get access to our live trade room. I'll share some very powerful futures strategies with you. This is right out of my personal Thinkorswim account, trading the E-mini S&P futures. I'm going to show you exactly how I accomplish this. Okay, and again, I can't guarantee anyone will replicate these profits, but what I can guarantee is that I will show you exactly how I am accomplishing these types of trades. We also do equities. So this again is right out of my personal trading account. Over the course of a week, it's not cherry picked. And again, I'm not trading any crazy position sizing. In many cases, just a few hundred contracts, and did over $4,500 in profit that week. So this is right out of our actual live trade room. We still have a few positions open from November that are doing many are doing very, very well. So this number is actually going to go up. But these are our booked trades for November. Okay, over $8,700. We still have some open positions that we're rolling over from October and November, but we've done very, very well. In fact, we 4x'd the S&P return over the course of a year. That means that what the S&P has just done, and we all know how much it's rallied, we beat it by 400%. This is the full track record because this is the month we actually have all of our positions closed out from September. We booked over $11,000 in profit. All right, guys. So you can see we have losing trades. I don't want to mislead anybody and think we don't have losing trades, but we are very, very consistent. Okay, and this is all accomplished using strategies like the golden one-day options trade and a whole lot of other ones. So now I want to make a promise to you. I want to help you have days just like these, and I'm going to give you access to trade alongside me in our live trade room. So this is a one-time opportunity to join me to discover how I make consistent income in the markets day after day, week after week. I don't hold anything back. So I don't give you a redacted, version of the strategy or indicator or whatever tool we're using. Okay, I give you the full thing. Every one of my special techniques and indicators that make profits like this possible. I don't hold anything back. And again, I'm not going to guarantee anyone will replicate my results, but I will guarantee that I will give you the exact strategies that I'm using to accomplish what I've shown you today. So I'm going to walk through quickly what you get for being here today. You get an annual membership to our Altos live trade room. You get the exact entry and exit signals for every trade. You get live interactive sessions twice a week. So we hold these on Tuesdays and Thursdays from 2 to 4 p.m. Eastern. We trade the last 2 hours of the US equity markets. These are all recorded. So in fact, a lot of our live trade room members don't join live because they have day jobs, or a lot are retired and out doing other things they enjoy doing, and that's perfectly fine. They watch the recordings for the learning experience because we send all the trades out by push notification and email. So they can place their trades on their smartphone while they're out on the golf course. Okay, you don't have to be there. That's totally up to you, but we do record everything. You get full supported coaching from me on these sessions, okay? And these are all proven strategies, tools, and education that you're probably not going to find at this level anywhere else, because it gives you the opportunity to trade alongside a professional hedge fund manager, okay? And I know other hedge fund managers, but I don't know any that will let you trade alongside them. Okay, so this is all designed to help you cut the learning curve and trade like a pro starting literally now. In fact, we're holding our next live trade room sessions tomorrow, so I'm going to let you know in just a second how you can join us starting tomorrow. But there's even more that comes in the package. So not only do you get exclusive access to our live trade room, you get real-time option alerts outside of the trade room. You get weekly live strategy sessions every Tuesday at 7 p.m. Eastern. So those are kind of like we did on our session today. Okay, we do a market overview, map out key levels, and cover a new strategy each week like we did today with the Golden Monday options trade. You also get exclusive invitation-only Facebook group access to our private Facebook group of about 900 members. Okay, you get our online trading curriculum, our professional trading series, which is over 10 hours of our very best strategies. You can watch it at your leisure. Okay, and ultimately learn to trade stocks, futures, forex, and options with consistency, which is of course priceless. And then we have two powerful bonuses: our price action pivot indicator, which is normally retailed at $9.97, and our course, How to Win 97% of Your Options Trades. This is another online course that goes through one of our most effective option selling strategies. So today we talk about an option buying strategy. If you like to sell premium, you have to have this strategy. We've been doing this, I've been doing this for much longer than a decade, but we've been doing this for a full decade with our members at Altos, okay? And we've exceeded 97%, okay? We've actually closed out over 400 net winning premium selling positions, and we currently have a couple open in adjustment, which I'm confident we will close out as net profits as well. Okay, that kind of consistency and results is unheard of in this industry. Okay, but you're going to get access to that exact strategy and how we accomplished it. So the total retail value on this package is over 10 grand, but you're not going to pay anywhere near that because we're knocking 88% off for the Tiger Shark trading event today. Okay, so over the course of a year, this will save you 88%. Okay, it's just $2.97 a quarter. It breaks down to pennies a day. Okay, and most of you are probably paying more than that to your broker and commissions. And for that reason, we do limit this to 25 seats. Okay, you can still get any of these things after those 25 seats are scooped up, but it goes back up to the retail price. So if you want in, the link is altostrading.com/LTR. You can join us starting tomorrow in the live trade room. And we also have an option if you want to lock in the full year to get an even bigger discount. So that's totally up to you. You have both options. All right, but I'm right at time. And so I just want to thank the Tiger Shark trading team for having me. It's always a pleasure to be here. If you do have any questions, please go to our website, altostrading.com. We have a contact form, our toll-free phone number and email are on there as well. You can reach out to us and we're happy to answer any questions and assist you with your new membership. So thanks again. I'll pass it back to you.